Well, run us through the sense you're making of the markets at the moment, where the bond market seems to be boasting the appeal and the equity game are not managing to keep up its allure.
Thank you, Alishia. I would agree with the analysts you've been speaking to who say the market's focus has shifted in a pretty big way to the bond market. And like you mentioned, the main and perhaps the only reason for that really is the Kenyan infrastructure bond, which is for 15 billion shillings and will be open for the whole entire month of September. So that really is what the market is looking like. And really anybody who's interested in looking at its effect on the equity sector really is only waiting to see how far trading is likely to fall in terms of volumes in the equity sector and how successful the bond will be. So it really is a bond watching period. And like you say, the news will be how successful the bond is and if it's oversubscribed or if it's able to achieve its target.
At the same time, though, we do have a few stocks stealing some attention. Total Kenya is a stock that has gotten a lot of local investor interest of late, and some saying mainly on the back of the fact that this is a company that has maintained quite a strong dividend policy over the years and that they're expecting this trend to hold. Do you share that sentiment around Kenya Total?
I think it's a good stock to look at because when you have a very stable dividend policy and generally a very stable company, even though their results in the current year were quite removed from what they've been doing historically. But generally, I think the market does expect a company like Total Kenya to continue to perform very well. And because of its stable dividend policy, it does offer some of the certainty and predictability many investors are looking for when they flock to the bond market. So it's a very useful stock to compare with because it's stocks like Total Kenya that are likely to prop up equity trading while investors are more concerned about certainty and predictability and stability in returns. So you are right, it's a good stock to look at, and you will find more and more people looking at stocks like Total Kenya.
Still in the oil marketing space, I mean, Kenol Kobil yesterday announced that it was embarking on a joint venture with South Africa's Kenyan into Zimbabwe. What is the market made of that news, and how do you expect that share price to perform now that the suspension is lifted off trade on Kenol Kobil for today?
Kenol Kobil is actually the largest oil marketer in the region. And with their expansion, you would expect it to send a very positive message to new investors. For some reason, it hasn't had the kind of stable performance you might have seen with some of the other counters you'd want to compare it with, just like Total Kenya we've been talking about. So it's a little bit more difficult to read because of the suspension that was there and because of its generally erratic trading. So I wouldn't venture a bet really on what it's likely to perform like, but I would say the sentiment towards the stock is likely to be positive. But because we don't have much history in terms of its dividend policy and its general performance, you might not see too much of a change from what has been happening previously.
I was talking to a broker yesterday during Power Lunch, and we were discussing the issue of the fact that we have seen Kenol Kobil's recent results not really impressing the market that much, and seeing that Zim is a long-term investment that's going to take a while, before it actually pays off. Can this company actually afford to wait for the benefits of this transaction to hit its bottom line?
I think it's a pretty accurate statement to make. I think because Kenol Kobil has been so active in the mergers and acquisition side of its business, we really do have to wait. Information is notoriously slow in slipping into this market and being digested by investors. So I would agree. I think they would have to wait. I think no one disagrees that being in the oil marketing sector and being a fairly it's like an oligopoly really with just a few dominant firms, its performance isn't too much in question, and it's probably a strong company that's likely to continue to grow. But in terms of being received by investors, I think we would have to wait for a lull, if you like, in its mergers and acquisitions so people can better digest and appreciate its true and intrinsic value and price that into their hopes for that counter.
Let's look at a company that has dominated its sector, and that Mumias Sugar. I mean, we've seen investors recently reacting pretty negatively to a new government proposal to enforce higher cane purchase prices on the one hand, as well as plans to increase imported sugar as well into the country. How do you see this impacting Mumias's bottom line as we move forward?
I think Mumias Sugar is an interesting company to look like, and it's a company that I follow quite a bit and like. I think it's a leader in its sector locally, and it's a pretty progressive company. And the big news for Mumias really is in its co-generation agreement with companies like Kenyan and in contributing to power on the national grid. And I think that's one of its biggest positive factors, the fact that they are increasingly becoming a more and more efficient company and almost fully self-sufficient in terms of their power requirements. The main issue in the sugar sector has been the competitiveness of the companies. And I've always liked the fact that Mumias looks to be leading the pack in terms of its competitiveness. So I would say that going forward, we should expect to see a recovery in its share price. It took a bit of a beating after a pretty rapid rise over the past maybe 1 or 2 years. So I would say it's a strong counter, and we're expected to see good things from it going forward.
Having said that, and having emphasized the fact that this is a company that has focused on its efficiency and diversifying its revenue streams as well, how do you see the market reacting to the privatization of other players in this sector, given that the current operating environment is one that they're facing as well?
I think the challenge there really is that the other market players, which are the other national sugar producing companies that will likely be privatized in the near future in order to comply with COMESA requirements, I think the issue is that they have such a negative and fairly long history of poor management and being overburdened with debts. It would take a while really for them to shed that image. Mumias has had the advantage of having been a listed entity for some time now, so it's been able to shed that image. But even Mumias had those challenges when it came to the market. I think you will find what I would expect for the strategy of a company like Mumias Sugar is to really dominate the sector even going forward, and perhaps even look to absorb some of these newly listed entities as soon as it's practical and remain the most relevant, the most dominant, and the leader in that particular category, and prepare itself for the onslaught when the COMESA barriers are broken down in 2010.